There you go. Good deal.
Yeah.
All right. In the spirit of being on time, we're going to go ahead and get started. Everybody, back to what is this, our second week? I think it's our second or third week of classes, and we are now on construction accounting. Um, just a few house rules. The homework. The homework we didn't receive last week because we had to double up the class. You will receive that in an email along with two the worksheets that I'm supposed to give you this evening. So I'll be doing that in the background. So I'll send you the homework questions and I will send you the worksheets in the background. Um, and without further ado, our construction accounting person will be Josh Roper of Altruist, and he will be presenting construction accounting and financial management. And he has the floor.
You're right. Can you see my screen?
Yeah, you can blow it up now.
Perfect. All right. This is weird. I generally like to see somebody. All right. So we'll go previous. All right. Good evening, everyone. How are you? My name is Josh Roper. I'm a CPA. I'm a partner in a firm called Altruist CPAs, and I'm excited to be here this evening doing a presentation for the 2025 USDOT MSA SBTRTC Bonding Education Program. I've been teaching this course for a couple of years now, and I really enjoy it. I really enjoy helping contractors achieve their goals and their dreams. And so what I'm going to do today is kind of give you some tips and tricks to help you along that journey. So the presentation today will be contractors' top 5 recommendations for success. Okay, and we're going to cover a bunch of topics. So I'll introduce myself again. I'm Josh Roper, CPA. I've been in the construction industry for over 20 years. I've been self-employed, working with small contractors up to $100 million for the past 10 years. 90% of my client base is contractors. I spent 4 years as a CFO controller for a large general contractor here in the state, and then decided that I wanted to work with more contractors instead of one. So I came out and opened my own firm about 10 years ago, and I've been working with contractors ever since. So contractors have a very unique set of service needs, and we try to encompass all of that into our service model. So we provide a test, consulting, fractional CFO, and tax services for contractors, mostly general commercial construction. I also serve on the board of the Georgia Construction Financial Management Association. And basically that is an industry association. It's a national network. They have a Georgia chapter, and it's an organization of CFOs, uh, controllers, accountants, and service providers for the construction industry. And its focus is on educating financial professionals in the construction industry. And I'll tell you more about that later. So that's me in a nutshell. Been working with contractors for a long, long time. It's my favorite group of people to work with. They're just great people, in the industry, and the businesses themselves have a lot of complexities, which make it a lot of fun to navigate. So let's get into the presentation a little more. So I'm going to give you my top 5 recommendations. We're going to build the right team. We're going to understand the financial reporting and tax options, develop internal systems to support the business needs. The most important, understand how the cash flows, and then how do we monitor everything that we've put into place and use it to monitor the success of our business. So let's start with building the right team, right? So you have an internal team. As you already know, you have yourself, the business owner, probably your accountant, your project managers, your supers, your labor, right? So that's your internal team. So, I see the best success in companies and small contractors where the owners are very hands-on, and they're involved in more than just operations. Some owners I only like to build, I only like to run projects. Well, you went into business for yourself to stop running projects and to manage other people to run projects. So you need to be involved in the operations, true, but you also really need to understand the financial aspects of your company as well. And a lot of contractors manage their company based off how much cash do I have in the bank, right? So that's not always the best way to manage your company. So we'll talk about that more. Do you have a CFO? You may not be big enough, right? So if you're big enough, a lot of bigger contractors have a CFO and a controller. And so when people ask me what the difference is, I summarize it and say a CFO is typically forward thinking and a controller is coming from a historical perspective. So the CFO kind of paves the path for the future, and the controller kind of summarizes where you've been. So the most important thing is, are they qualified? Do they have proper education and proper experience? And do they understand your industry? A good accountant for a trucking company may not be a good accountant for a construction company. They have very different accounting needs and intricacies that are involved into the accounting system. So operations, is it symbiotic with accounting? Does accounting participate in the, or does operations participate in the accounting process, right? So a lot of people like to bifurcate accounting and operations. You know, operations build it and accounting just counts it. But there's really a symbiotic relationship where one can't survive without the other, right? The project managers bring in the money, the accountants tell them how they're doing on their jobs, and they should work together to be able to get the best outcome for the company, right? So look through your internal team and say, do I have all of these people on my internal team, and am I operating in a symbiotic nature within my company to be able to achieve the best results? So then you have your internal team, and now let's talk about your external team, right? So let's talk about the bankers. Do they understand construction, and do they understand your business? That's very important. A lot of banks claim to like contractors, but a lot of banks don't understand contractors. So everybody likes every business when they're all making money, right? When they're not making money, that's when you need a banking relationship that understands your business to be able to help you either stay the course during downtime while your backlog is low, or fund your next project, or invest into your company to grow. Uh, Insurance agent. Is your insurance agent an industry expert? Do they understand the construction industry, right? Property, casualty, general liability. That's kind of what we're talking about there. Also, your bonding agent, right? I'm sure everybody's had a bond at some point. So your bonding agent is a relationship. So communicate, and I'll talk more about that later. But I always like to say, your bonding agent should be like your banker and your CPA. It should be a collaborative relationship to where you're all working together to help your business achieve the best results. Attorney, again, is your attorney an industry expert? Do they understand construction contracts, subcontracts, liquidating damages, paid when paid clauses? Do they understand multi-state issues, right? So your attorney needs to be an industry expert as well. And if you start out, I would recommend that maybe not, an attorney doesn't review every contract, but maybe you come up with a master contract for your company and have that reviewed by an attorney. So that way, at least you have the majority of your issues covered, and then your only exposure is from contract to contract. Financial advisor, you need one for your business and your owner. So you may get to a point where you have discretionary funds and you want to invest them into investments and hold them. So maybe you need them for collateral for bonding, or you may need the cash one day, or for the business owner, right? So a lot of what I preach is for privately held business owners, the majority of their wealth is tied up into their small business. So so what I do is I help you grow that business and maximize that value in the business, and then rewards that you gain from that business, i.e. income. That's when you want to engage a financial advisor for your personal level as well, at the owner level, right? So the financial advisor takes care of the business, investments, 401k, and then you have your personal and financial advisor, could be the same person, that takes care of your personal investments and helps you towards your retirement goals. CPA, hey, I love CPAs. Are they an industry expert? As we'll go into, as the presentation moves on, there are a lot of details and intricacies that for construction contractors that the average CPA may not know. So is your CPA a construction industry expert? I can tell you it makes a huge difference in how you report your taxes, how you pay your taxes, and how your business grows. And a bookkeeper if needed, right? So everybody starts out at their own different pace. Joanna and I were talking earlier, the first two things that you unload when you're a small business is your payroll and your bookkeeping, right? So that's not what construction contractors do. So you want to make sure that you have good bookkeeping. If you're not doing it yourself, hire somebody to do it. It's incredibly cheap compared to the value that you will receive for the information in a organized, accurate, and timely manner. Okay. So that's building the right team, right? We have our internal team, we have our external team, and you just need to make sure that you have all the people that are invested in your success and are invested into your plan for the future of your company. And that's how you know you've got the right teams, both internally and externally. All right. So let's understand the financial reporting and the tax options. Okay. A lot of people don't know for financial reporting in construction, there's a bunch of different methods that you can use. And for income tax filing, there's a bunch of different methods that you can file on. And what you need to do is you need to look at how your business runs and how your projects perform and adopt the method that best suits your business. Okay, so for the accounting method, I always say the accrual method is the best method for managing your company, not necessarily for filing your taxes, but absolutely for managing your company. You should always know what your accounts receivable balance is at any time, right? You should always know who owes you money. You should always know who you owe money to, right? So just writing checks and depositing checks, that's great, but you also need to take into consideration the future, right? Your future cash needs. So I always say the accrual method is the best, but a lot of people use a hybrid, right? We may use AR and AP, but not go full accrual and do everything else on a cash basis. Sometimes that works too, right? It just depends on your business. Revenue recognition, this is a big one. This affects your financial statements, and this also affects your income tax records. So let's take a minute before I get into RevRec and income tax filing and talk about two sets of books. Now, I know that sounds a little shady, but it's not. Every business has two sets of books. You have your financial set of books, and those are the ones that you manage your business off of and that you give to external parties for reporting purposes. And then you have your income tax filing books. And that's the set of books that you use to report your income tax obligation to the government, okay? They're the same set of records, but they can be manipulated to achieve the same results. So for example, revenue recognition, do we want to use percentage of completion? When do we use percentage of completion? When typically we have contracts that cross over periods, have a long life cycle, and have a reasonable ability to estimate the cost of completion on those jobs as the job progresses, right? So I have a contract that takes me 6 months. I probably want to use the percentage of completion to see how I'm progressing on that job from revenue, profitability, billing, cash flow, right? But you may not, right? So you may say, okay, what if I build houses, right? Houses are a great example of completed contract. It's also required for houses, right? So if I'm a home builder and I go build a house, I'm not going to recognize any cost as an expense, and I'm not going to recognize any revenue as income until the house is done. So I'm going to defer all my costs, I'm going to defer all my revenue, and when the house is done and we sell it, then I recognize everything and it hits my income statement. Or is it time and materials, right? Or time plus, right? So you're going to get out there and throw in your materials and your labor, and you're going to mark it up 10 to 20%. That's an easy way to bill it, right? And you can measure that progress in real time most of the time, right? So what's the best revenue recognition method for your company based off your type of projects, all right? Then also the income tax filing, right? So most small businesses under $29 million of average annual revenues file on the cash method of accounting. There are some exceptions, like if you're selling inventory, but for the most part, if your business is under $29 million, you should be on the cash basis, right? Not all the time, but most of the time, right? So that means you're not paying tax on money you haven't received, and you're only paying tax on money that you have received, and you get to reduce it by cash that goes out the door. That's the most common, but it's not always the most appropriate, right? There's the accrual method. We've talked about that. So if you have 3 years of average revenues over $29 million as a contractor, and you have long-term contracts, you're required to use the percentage of completion method. All right. And then there is the percentage of completion method. You typically won't use that until you're required to. You don't want to. It's not the most advantageous. The completed contract, that's also a tax method. We talked about that. If that matches up your revenues and expenses to not unburden you unnecessarily, or to burden you unnecessarily. So for example, if I'm building a house in December and I pay all those costs in December, I get to deduct all those costs against the income for December. But then when I sell it in January and I get the income, I don't have any costs to offset that income. So I have a mismatch of revenues and expenses, right? So we want to make sure maybe we want to do the completed contract method to better align the profitability of our projects. There's also, if you're using the accrual method with retainage, you can exclude retainage receivable and payable. So if I have grading contractors who have retainage that's held for months, 6 months, year, right? They're the first ones on the job and the last ones, to get their retainage paid out. So, for the income tax code says, okay, well, we're not going to make you pay taxes on that retainage that you're going to wait another year for. So you can make an election to defer or not tax your retainage until it's received. But the flip side is you have to, if you're going to do that for receivables, you have to do it for payables too. And then there's the percentage of completion with a capital cost method. So if it's residential and it's a combination of residential and commercial where you can do 70% residential and then percentage of completion for the other 30%. That's typically for like multifamily builders. So what you see is you have 6 different methods, bases is what we call them, bases, that you can file your income taxes on, right? So you want to make sure that you're doing the best one that reflects the cash flow and the nature of your projects, and the same with the revenue recognition. Now, if you get into reporting, financial reporting, attest reporting with audits, reviews, or compilations to your bonding and license agencies, most of them want to see it under percentage of completion unless your business dictates some other method. Does that make sense? So really take a moment and understand what's the best method of revenue recognition and what's the best method of income tax filing. The best method of RevRec is one that reflects accurately the progress or the economic impact of your projects. The best income tax filing is the one that allows you to pay the least amount of taxes in currently. You always, the tax strategy is always, I'll gladly pay you my taxes tomorrow, right? I'll pay them tomorrow. I'll pay them tomorrow. So you always want to kick the can down the road. So we pay as little taxes as we can, but we want to gain as much economic impact on the financial statements as we can. So let's do a polling question right now. So how many of you how do you keep your internal books right now? Are you keeping them on the cash basis, the accrual basis, percentage of completion, completed contract, modified cash, which means you have receivables and payables, but you're not accruing anything else, or other? So I'll give everybody a second. Can you launch that, Joanna? Joanna, are you there?
Yes, I'm here.
Can you? Okay.
Launch. Okay.
All right. So if we don't have the polling question, let's just put it into the chat.
Okay.
All right, I see one cash basis. I see one accrual basis. Love it. Love it. Okay. So cash basis, again, what I would say is you want to make sure that you're capturing your receivables and you're capturing your payables, right? So the best way to do that is start recording those as the invoices come in. All right. So cash basis is good. I like cash basis for tax filing, not for financial statement management. All right. Thank you for participating. Okay. So the next question is, So we talked about financial reporting, we talked about tax reporting, right? So they have an inverse relationship. So you want your financial reporting to be strong, you want your balance sheet to be strong, your equity to be strong, your profitability, your working capital. You want your financials to be to boast you and make you as grandiose as possible, right? We're doing great. We're making a lot of money. We're profitable. But on the tax side, we want to cry poor. No, we don't have any money. Sorry, IRS. So what we have to do in the construction industry is we have to walk a fine line to be able to balance our financial reporting and our tax reporting. So I'll give you an example of that, right? We don't want to pay any income taxes. So we may want to minimize our income as little as possible so we pay as little as tax as possible. But now, if we give that financial statement to our bonding agent, they may say, you know what, you weren't very profitable last year, so we can't write you a bond based off of the profitability and the state of your balance sheet right now. And you go, well, I didn't think of that. I need that bond, but I didn't really want to pay taxes. So sometimes you have to pay a little more taxes to be able to show a stronger balance sheet. So what we do is we say, okay, we go, all right, so here's what we do for our clients to achieve this goal. So we do what we call tax and bond planning at the end of every year. So that process starts in August. And what we do is we meet with our contractors and we say, okay, how have you done so far this year? What activity have you had that impacts your tax situation this year? What's your profitability? Have you invested in a lot of assets, right? Because depreciation affects taxable income. Okay. And then we say, what does it look like the rest of the year? And then we do a projection for the rest of the year and we say, all right, this is what our profitability is going to be for the year. And then we run an income tax projection based off that profitability. So we sit in November and we go, okay, this is what our balance sheet's going to look like. And this is what our tax liability is going to look like based off of that balance sheet. Now I want to minimize the tax liability. What's my stopping point on the financial reporting piece, right? So if you go back and I talk about the external team, right? I talked about your bonding agent, right? So you have two factors that drive your financial reporting. You have lending, well, three: lending, licensing, and bonding. All right. Licensing is the easiest one to get over, but lending and bonding are the most difficult, right? Because they're actually giving you credit. So we have to make sure that we have financial reporting that's strong enough that's going to make that allow the bank to give us a line of credit or a loan for equipment. We have to have financial reporting that's strong enough that the surety and the bonding agent is going to write that bond for our next project. Okay. But we again want to minimize that tax liability because we want to keep that cash in the company or put it in our pocket and reward ourselves for a hard year, right? So going back to the bonding agent, it's a relationship. So you call up the bank and you say, hey, the bank usually your equity or your loan covenant requirements are in your loan documents. So that's easy. So you call the bonding agent, you say, Mr. and Mrs. Bonding Agent, we had a really good year. I want to take some money out. I've been putting money in for a long time. I deserve to take some out. How much can I take out? Well, the bonding agent's going to reply, well, what does next year look like? What does your backlog look like? What does your bonding situation look like? Right? Most companies don't bond every job. They bond certain jobs, right? So if you go, okay, I'm in November and I'm a $10 million contractor and I may have $2 million worth of bonded projects next year, then the surety or the bonding agent will say, well, we need to see this level of equity and working capital in the company to be able to write those bonds. So then you take distributions to get your cash, your working capital, and your equity down to that level. That gives your financial report credit to be able to write bonds and keep your loans. And then we've minimized that tax liability as much as possible, right? So it's kind of it's a balancing act that we have to look at every year. Some years are more critical than others, depending on bonding needs, growth needs, and then how much the owners want to take out, right? So construction contractors are always famous for taking the money out as quickly as it comes in, right? So sometimes as you grow, we may want to leave some of that money in the company. And what that does is that tells the bank and the bonding agent that you have an stake in the liability and the risk as well. Does that make sense? So financial versus tax, it's an inverse relationship. Maximize our financial reporting, minimize our tax reporting every time. All right. So let's talk about some tax benefits from contractors. Contractors, again, are very unique. Okay. So there's work opportunity credits. That's hiring from targeted groups. For example, veterans, formerly incarcerated. So if you're a high labor contractor who's hiring from these targeted groups, then what you want to consider is the work opportunity tax credit. So you can get, I think it's $1,000 tax credit per hire for these targeted groups. It also works for if you're doing work or making hires in targeted locations, right? If you have a depressed area and they're trying to help employ people in that area, they'll give you credit for that. So what I recommend is if you don't already, there's a form on the IRS website. You can Google it. Just Google work opportunity credit form and take this form and put it into your hiring packet. So every time you hire a new employee and they're filling out their W-4 and they're filling out their G-4s and they're filling out their I-9s, right? Throw the work opportunity tax credit form in there and as well and have them fill it out. And once you review it after they fill it out, if they qualify, then the owner of the company could get a tax credit for doing something they were already going to do anyway, and that's hire that individual, right? So work opportunity tax credit's a great credit, it's overlooked often. Take the form, put it in your hiring packet. That way you'll never miss an opportunity. Okay. Research and development, if you're doing design build, if you have some sort of engineering component, you may want to look at R&D credits, Georgia retaining credits. So for a Georgia contractor, anytime you invest into your company with new technology to improve your processes and train your employees, Georgia rewards you by giving you a credit of up to $1,250 per employee, right? So you're a growing contractor. You may start out with QuickBooks, you may upgrade, right? You may put in a project management module, right? You may put in a scheduling module. Ooh, the big one, time entry, right? So anytime you're using technology, you're investing in technology to change your processes and educate and train your staff, Georgia will reward you with a credit. So what I tell people to do is, let's say we're going to implement a new ERP system, right? Then create a job for a new ERP system, code all your costs to that job, have your employees code their time to that job, just like they would any other job. And then at the end of the year, you have a job report, which you're all familiar with, of all the costs that it took you to implement your new software. And it's easy to calculate the amount of credits you're going to get after that. So that's also often overlooked, right? It's a state credit specific to Georgia. There's also opportunity zone credits for low-income housing. But they work the same way as the retraining credits, as the film credits, I'm sorry. So the retraining credits are for investment in technology, but there are also other ones like film credits and opportunity zone credits that you can purchase and minimize your state tax liability as well. Retirement plan, right? So as an owner, I can tell you as a small business owner, the number one tax planning strategy is retirement savings. You're making a lot of money, you're taxed at a higher rate. We want to defer it at a higher rate. When you retire, you pull it out. You don't need as much money. It gets taxed at a lower rate, right? In addition to that, your employees may want to retire, I'm sure they all want to retire, but they may want to save for retirement, right? So implementing a retirement plan is something that's great for your company. It allows you to save, allows you to get tax deductions, but it can also do the same thing for your employees. And it's really a nominal cost when you look at the benefit that it provides company-wide. But the great part about it is you can get a credit for the first year of implementation for a retirement plan. And so that typically works off the amount of cost that it takes to implement the plan and the amount that the employer matches, right? So if you're implementing a retirement plan, a 401k plan, there's a retirement plan first year credit. So take advantage of the credit for something you're going to do anyway. Let's talk about state taxes. So Georgia in 2022 implemented what's called a pass-through entity tax. So most small businesses in America are pass-through entities. That means they're S corporations, partnerships, or single-member LLCs. There's a couple of other variations, but those are the three main ones, right? And so historically, what happened is if I have a pass-through entity, the business earns the money, they report it on a K-1, I report the money on my individual return, and then I pay the taxes at the individual level. So the income I earned at the business passes through to me individually, and I pay the tax for it at the individual level, right? So what happened is in 2018, there was a tax law passed that capped the amount of state taxes that you could deduct at $10,000. So if you can imagine, if you're making, two, 300, 400, $500,000 a year, your state taxes are going to exceed $10,000. So you're not going to be able to get a full deduction for it because of the $10,000 cap. So what Georgia, and I think it's up to about 32 other states have done at this point, is they said, okay, we passed a law called the pass-through entity tax. So that means if my business earns $1 million, I can pay tax on that $1 million at the entity level. So that's going to be $60,000, right? So it's going to be $60,000 in tax that I'm going to have to pay that I'm not going to get a deduction for because that income is going to pass through to me personally and it's going to be limited to 10 grand. So I'm going to lose a $50,000 deduction. Well, Georgia said, okay, if you pay it at the entity level, then you can deduct it 100% at the federal level. So if you can make a PTE election, pay your Georgia tax at the federal level, and take a full deduction for the $60,000 at the federal level. So what it does is gives you a $50,000 deduction at the federal level you wouldn't have had otherwise, right? So the pass-through entity tax is a really great benefit for small businesses in the U.S. right now. Now that could change within the next 30 days. And a lot of the pass-through will start expiring at the end of this year. Well, for 2024 and for 2025 right now, it's still into effect. So I would advise, make sure that you're working with your accountant to take advantage of that. If you're doing the percentage of completion on a tax basis, if you're filing on a percentage of completion on a tax basis, you get to exclude the gross profit that you've recognized on projects that are less than 10% complete. So what the IRS is saying is, we're not going to burden you with profit on a contract that you just started making money on because you probably haven't even collected that money yet. So they allow you to defer the gross profit on that 10% until next year. It's really nice. So state tax credits, again, as we talked about, there's film credits in Georgia. There's opportunity low income housing credits in Georgia. And typically what that'll do is save you about 6 to 8% on your state taxes, which is it's a nice savings depending on how much it is. And then depreciation. This is huge for contractors, right? Because we're always investing in trucks, we're investing in equipment, right? So we have to make sure that we take the most advantage of the depreciation that we can. Okay, so what the IRS does is they have 3 ways that you can claim depreciation. We'll just say 3 for argument. With IRS, it's always if then, right? So they have a endless amount of if thens to keep you in circular equations. So we'll keep it to 3. So you have regular depreciation. So if I buy an asset, then I depreciate 20% in the first year, 40% in the second, 40% in the third, 20%, 10% in the fourth, 10% in the fifth, right? So that's regular depreciation. Well, that's over, a multi-year period. So what the IRS says is, okay, for investment purposes and to help you invest into the economy, we'll let you accelerate your depreciation on assets that you buy in the year that you purchase it. So you can do that by making an election. It's an election called Section 179, and it's an election to expense an asset fully in the year that you purchase it. So if I buy a truck, it's $50,000, and I don't make an election, then I have to depreciate that truck over 5 years. So that's 20,000 or 10,000 and so forth. If I make a 179 election, then I can write all $50,000 off in the year that I purchase it. So on December 31st, if I go buy a truck on December 31st and I make a Section 179 election, I can write the entirety of that truck off, only owning it for 1 day of the year. Okay. So 179 is a wonderful, wonderful election. It is an election for a deduction to accelerate depreciation. Okay. There's also bonus depreciation. So when I started this business, there was no bonus depreciation. Then we had the house. And so let me put it in perspective. When I started 25 years ago, Section 179 was limited to $25,000. Today it's at like 1.2, right? So that tells you how much it's grown and how much they value small businesses investing into the market. Okay. Bonus depreciation didn't even exist. So bonus depreciation came about the first time that I remember it with the housing crash of 2006, 2007, because the market was down, nobody was spending money. So 179 was at $25,000. So they came and said, okay, we're going to offer you bonus depreciation, which means you can write it off at an accelerated pace in the year of purchase that exceeds 179. Okay. So people would say, oh, let's do bonus depreciation. And bonus depreciation has basically stuck around since then in some shape, form, or fashion, but really came in full speed with COVID, right? Well, it came in with the 2018 Tax Act. That's when it really came in. And so what happened was bonus depreciation went up to 100%. So you say, well, why would I do bonus? I've already got 179. Well, there's a bunch of different reasons. 179 can't create a business loss. Bonus depreciation can, right? But the problem with bonus depreciation is it's on a declining scale. So for 2018, it was 100%. For 2019, I think 2018 to 2020, it was 100%. And then it's been scaling down every year since. So for 2024, it's 60%, and 25, it's 40%. Okay. So that means that my bonus depreciation only give me 40% depreciation. Well, I might want to select 179, which could give me 100, right? But again, there's always if, then, and circular equations when it comes to tax, right? So I may want to take 179 because most states recognize 179. So there won't be a state tax difference. So if I buy a $50,000 car, I 179 it, I get a $50,000 federal deduction and a $50,000 state deduction. Okay. Most states don't adopt the bonus depreciation. So if I buy a truck for $50,000 and I get 100% federal bonus depreciation, the state says you get zero bonus. You have to use the regular method. So I could get a $50,000 federal deduction and only a $10,000 state deduction, right? So I don't want that disparity. So I would probably go with 179. But let's say that I had some taxes in the prior year, or I had some losses that I wanted to generate because maybe I had some income from another source. Well, then maybe I want to take bonus depreciation because I can create a loss to offset some other income, right? So for contractors and most small businesses that invest into assets, depreciation is one of the biggest areas where you can reduce your tax liability at the entity level. So before they made everything bonus depreciation, hey, if everything's 100% deductible, nothing matters, right? But when it gets to 40% bonus and 1.2, 179, you have to sit there and figure out which method provides the best advantage and the most cash savings for you in the year of purchase. Does that make sense? So there are a lot of considerations at the tax level that you have to take into consideration from a cash flow standpoint, right? Some other things, right? If you're buying a building, anybody heard of a cost segregation study? All right, there's no polls, but if you want to go buy a building, you could do a cost segregation study. So let's say I buy a building for $1 million. Well, the IRS says I've got to depreciate that for 39 years. Well, I can do a cost segregation study and reclass 30% of that to immediate Section 179 or bonus depreciation and get a 30% bonus. So think about it. If you go buy $1 million business or building, you could write $300,000 off in the first year. That would basically give you the cash back that you paid to put down on the building. So you could take that cash and go put it in the next building. So cost segregation studies are a great thing to consider. But none of this matters because in the next, I don't know, he's been in office 7 days, 8 days. So in the next 92 days, there's going to be a major tax package passed. And the unknown, we know it's going to affect 2025 for sure. Sometimes the government loves to do these hidden gems, like we CPAs like to call them, and they'll make it retroactive, right? So they did that a lot during COVID with the PPP and the Inflation Reduction Act and the ERCs. A lot of the stuff that they passed was retroactive. So if you filed your return, they changed the rules, you'd have to amend it, right? So I see some of that happen in 2025. But for the most part, I think we'll get one of the largest tax packages the country's ever seen this year. So get ready because everything's going to change. But I don't complain. It's free marketing for me, right? So tax benefits, there are a lot of are a lot of unique benefits for contractors. If you're a home builder, you can get 45L credits. If if you're an architect engineer, there's credits for you there. So depending on what you do in the construction industry, there's generally some sort of building credits that you can get, whether it be clean energy or whatever. So make sure that you're taking advantage of all of your special tax considerations for contractors. All right. Let's see. Okay. So let's talk about developing internal systems, right? So we have a lot of systems that go through our company and sustain the processes and information for which flow through our company, right? The most important process in the construction industry is the estimating process, right? Anybody disagree? Please let me know, because one estimate can take the company under, right? So you have to make sure that your estimating process is one of the most monitored processes that you have in your company, right? So I'll give you an example. 4 years ago, I had a company, their concrete company, in COVID, had a bunch of contracts signed, okay? But they kept signing contracts through COVID based off the same estimates. But what they didn't take into consideration was concrete was almost non-existent during COVID. So the demand went way up, but the supply went way down. So the price went way up. So they weren't monitoring their estimating process, okay, on their job, on how they were estimating their jobs. So they were entering into contracts where they were losing money and didn't even know it. Does that make sense? So you always want to make sure that you're reviewing your estimating process to make sure that it's staying with the times for cost of construction, but also you want to monitor it. So if you're doing an estimate for a job that you've already done, right, then you can leverage off that estimate to make sure that you tighten up your current estimate. All right. But other things you want to do, is everyone doing estimating the same way? If you've got 4 people doing estimates, you all want them estimating from the same template, right? All right, that just makes it easy. Do your estimates coincide with your job cost, right? You estimate to bid the job, you job cost to determine how well you estimated. Does that make sense? So they should almost mirror each other from a line by, they're not going to go line by line, but if I have project management in my estimate, it's going to hit my labor for GL. If I have contractors in my estimates, it's going to hit my subcontractor expense on my job cost, right? So, and then when you go through at the end of the job and you're doing an actual to estimate budget analysis, then you can see where you had successes on your estimates. Maybe you had good buyouts. Maybe you finished quicker than you thought. You didn't have scheduling delays. Huh? Or maybe it was an execution issue, right? So you always want to make sure that you have your estimates. Are your and that they coincide with your job costs for comparative purposes. What do your estimates include? Do they include direct costs? Or do they include indirect cost, right? So if I'm a concrete guy, and everybody does it a bunch of different ways, okay? So if I'm a concrete guy, I may only include in my estimate materials and labor because that's the most important thing to me and getting that job done, right? But if I'm a GC, I'm going to include materials and labor. I'm not going to have a lot of materials, but I'll include labor and sub costs. But there's also indirect costs, right? There's depreciation. We've got all these trucks that are running around out there. We bought those trucks for jobs. How do we make sure we capture those as a job cost? Okay. So we have to make sure that our estimating process includes direct, especially, but also indirect costs. A lot of people call that burden, general conditions, right? Make sure that we include that in our estimates so we compensate. One of the biggest pieces on smaller contractors that I see is project management. Okay. So project management is considered management. Well, you wouldn't have a project manager if you didn't have a project, right? So project management is a project cost. So is your project management incorporated into that as well? And as we get into full absorption accounting a little later, I'll show you how other costs may belong in there as well. So let's talk about project management. What are you using to manage your projects? Are you using the software? Are you using Procore? Does your ERP system have a project management module in it? If you're using a third-party project management software, does it integrate with your accounting system? Okay. One of the biggest, right? Project management has the modules have a bunch of different features, budgeting, scheduling, right? Is change order management. Change order management is either it could equate to lost profits, right? So how are you managing your change orders? We have our original contract. Now we're going to issue a change order. Are we incorporating that change order into our job costing? Are we incorporating that billings and that contract amount into our contract amount? All right. One of the things, and then change orders apply to both the owner and the subcontractors, right? So when I was a controller or CFO for a general contractor, we used to correlate our subcontractor change orders to our owner change orders. So if we're issuing a subcontractor a change order, why? So is that a missed scope? Is that a missed execution? Or are we doing additional work outside of scope that we should go back to the owner and issue them a change order, right? Because we don't want to incur costs unless we're going to get paid for them, right? So change order management is huge, all right? Accounting system. Generally, it's easy to get information into an accounting system. It's typically more difficult to get it out, but you want one that facilitates both. We want it easy to get in and easy to get out. Are you using it to its fullest potential? Are you using job costing correctly? Are you using estimating correctly? Are you using billing correctly, right? Do you have restrictions and or limitations? I'll give you an example. So billing to an owner sounds like an accounting responsibility, right? It depends. So if it's a percentage of completion job, nobody knows the progress billing of that job better than the project manager, right? So we would have the project managers prepare the owner pay applications. They would submit them to accounting. We would review them and make sure that they were right from a billing perspective, make sure we weren't financing the job, make sure the owner is. And then once we approved it, we would issue it to the owner. So are you utilizing, and that goes back to that symbiotic relationship between between operations and accounting, right? Because we always want to get to the best outcome. So I'll give you an example. So the reason a project manager may say, hey, we're 30% complete with this job, so we're going to bill 30%. All right. In that mind, that's what the project manager says is 30%. Well, the accounting department may come up to him and say, well, based off your estimate and the costs we've incurred to date, you're really 40% complete. So if we send out your bill the way it is, we're underbilling our customer, and that means we're financing this job. The goal is to never have you, the contractor, finance the job. The job's not yours, so you shouldn't be financing it. The job is the owner's, so they should be financing it. So you need to make sure that you have proper restrictions and limitations and segregations of duties and checks and balances to make sure that you're not financing your job. Do you have proper segregation of duties in the accounting department, right? You don't want someone issuing receivable invoices and depositing cash. You don't want someone bringing in the vendor invoices and setting up vendors and paying them, right? You don't want someone initiating a wire transfer and having the ability to authorize it, okay? Because if they can do that, they can clean you out. And I can tell you, you say, well, my most trusted person is the one that's responsible for that. Statistics show you your most trusted person is the one that's going to steal from you because they're your most trusted person, right? So even though they're your most trusted person, there is absolutely nothing wrong with having a segregation of duties put in place to protect you, the owner, and your business. I'll give you an example. I had a client, I had to let him go last year. Didn't want to do any of these things that we're talking about. He did them for the first few years and then just got busy, got lazy, couldn't find good help. It's not all on him. There's always a myriad of factors, but didn't want to, keep an eye on the progress of the jobs. So what happens was he started losing money and he started slipping. So you have to be able to make sure. And then what happened was he took his eyes off the ball so much, he didn't have proper segregation of duties. His controller started stealing from him. First it was credit cards, then it was fake vendors, right? So that's real. So, but if he had proper segregation of duties where he signed all the checks, she had a credit card limit, she could only transfer she could only initiate transfers, not execute them and initiate them. It would have limited his exposure. Okay. And the biggest thing about the accounting system is, are you getting your financials timely? Right? If you're getting January financials in March, they're not doing you any good other than telling you how much money you made in January. They're not going to tell you how to navigate February because you're already in March, right? So getting financial statements on a regular, monthly, timely basis is crucial to monitoring the accounting health of your company, right? So come up with a system, make sure they're out by X date. We'll go over this a little later, but timely financials, and it's also a good indication of how successful your accounting department is, right? If you can't get financials from your accounting department, then something's wrong with your accounting department or something's wrong with your overall processes, right? So we want to make sure that if everything's working smoothly, we're getting financial statements, not as quick as our bank statements, but pretty soon thereafter, okay? And then there's other systems that you need to look at. Service module, right? If I'm a plumber, does my service module integrate with my QuickBooks? If I'm an electrician, same thing, right? Payroll processing and timekeeping and expense reporting. I'll put all three of these together because these are probably the biggest pain points for contractors who job cost in the industry, right? So let's talk about how we get how we simplify this. We get a good timekeeping system, okay, where everybody keeps time. Everybody in the company should be accounting for their time. Timesheets, enter them in. That way, accounting can properly allocate them to the jobs. And then we have a payroll processing. The most important aspect of payroll processing is paying the employees. The second most is paying the government. And the third most is job costing. So do we have a system that allows our timekeeping and our payroll processing to job cost in a timely and effective and efficient manner? So when I started CFO of construction company, payroll process from the day the timesheets were turned in to the time it was paid to the time it was job costed was a 4.5 day process. We were doing manual timesheets through Excel. They were compiling all the data, formulating it into an Excel spreadsheet, then manually doing data entry. I came in and said, this is crazy. We implemented a timekeeping system, implemented an expense keeping system, and then we took payroll from a 4.5 day process, and payroll includes job costing in construction. We took it from a 4.5 day process to a 1.5 day process, just using technology and changing our processes. So then my payroll person, who was spending 4.5 days a week doing payroll, she also got to start helping me with accounts payable invoices as well. So that's with huge timekeeping is a huge time suck and a huge ineffective, inefficient process in the construction industry. I would advise everyone keep timesheets and give them a good system that integrates with your accounting system to be able to job cost it properly. Same thing with expense reporting. Expense reporting is a little less formal. You're giving out them company credit cards. Expense reporting is very important though, in that you get good receipts and good timely job costing for it as well. All right. So we want to develop all of these internal systems to take care of the most important parts. Our estimating, that's how we got the job. Our project management, that's how we get the money that we estimated on the job. the accounting system tells us that we got all the money that we estimated, and all these other systems help integrate in to make sure that we get timely information to know how we're doing on the project. All right, so let's do polling question number 2. So do you job cost your jobs? If so, do you do it with materials only, materials and direct labor, all direct and indirect cost, or no, we do not job cost? Can you put some comments in the chat for me? Anybody? Anybody? Is anybody job costing? All right. I got one C. I love that. That's awesome. All direct and indirect costs. Great job. We got one not at this time. That's again, I could show you the value, the importance. So let me talk about job costing, right? Here's one of the, obviously, you know, the profitability on your jobs. One of the interesting things, and being a CPA for years, that I never even considered when I went to go be a CFO of a construction company, you know, when I go to job costing, I think to myself, job costing is the accountant's responsibility. The accountant reviews it, right? That's not always true. It's rarely true. The project managers are heavily involved in job costs. So 60% of all construction companies bonus project managers based off the performance of their jobs. So project manager ABC is doing a job for 100,000. He's got a $90,000 budget. He makes 10 grand. He's going to get a 5% bonus on that 10 grand if he makes 10 grand. That's what was estimated. Yay. Project manager ABC is going to be watching every cost that hit that job to make sure nothing's coming out of his bonus. So if you have an accounting department with 3 people in there, you got 3 people looking at job costs. If you got an accounting department with 3 people and 5 project managers looking at job costs, you have 8 people looking at job costs now. So I can tell you the first person that was in my office when one of the accountants made a mistake wasn't the owner, wasn't the assistant controller, wasn't anybody in the accounting department. It was a project manager every time. Okay. So that's another great benefit of job costing is A, you get to know your jobs, you get to see the profitability on your jobs, and it helps you estimate your next job. But you also get X number of set of eyes of all your costs and internal controls on those as well. Just really great, something that I learned when I was working for the construction company that I didn't realize. All right, so let's go back to the PowerPoint. All right. For some reason, my window's not wanting to open. Okay, there we go. All right. I'm going to assume everyone can see my slide. If not, somebody holler.
You're good.
Okay, so do your job costs. All right. So for those of you who are not, please think about it. Okay, so again, we talked about job costing should mirror estimating. Simple job costing, direct materials, direct labor, other direct costs, permits, insurance, stuff, bonds, right? Full job costing, direct materials, direct labor, other direct costs, all direct costs. Project manager, we talked about, that's direct job costs. Other indirect labor, operations and accounting, right? So larger construction companies have all companies have accountants, right? Larger companies have job cost accountants, right? So every job cost accountant is working on a job, right? So that's a cost of that job. You wouldn't have the accountant if you didn't have the job, right? So it's a job cost. So what we used to do is we'd say, okay, 80% of all of our accounting department is working on jobs, and we were, and 20% is working on the company, which we were. So we would allocate 80% of all of our accounting labor to the jobs because it is a job cost. Job costing is a job cost. Insurance, you have your general. All right. Are you allocating your general insurance cost into your jobs? Typically, you do that with an insurance rate, right? So I'm going to charge 1% to all my jobs to cover my GL cost, right? But that's a cost to you. That's a job cost. You wouldn't have it if you didn't have jobs. Workers' comp, that's a little easier, has a direct correlation to labor. Do you have any others? Again, we talked about bonds, any other special insurance coverages that you may need, like a rider or an umbrella or something for a particular job. We talked about uses of company assets. If you're an excavator, if you're a dirt mover, right, and you have all these big machines out there, that's a cost of the job that you're working on. Do you have a usage rate? Are you allocating depreciation? All right. Think about electricians. They've got all these trucks on the roads. Plumbers got all these trucks on the roads, right? That's a cost of the job. Even though it may be a little job, it's still a little cost of that little job. Are we using a burden rate for allocating that cost of the vehicle to the job or the equipment, right? And then there's other direct, indirect costs. One of the ones that we talk about, depreciation is a good one, right? So depreciation is a job cost, how you allocate it. It may not just be trucks or equipment. It could be, office, right? Project manager's desk is a job cost, right? So, all of that should be taken into consideration. Then you have general conditions, right? So these are the different kinds of job costing that you can do. We have simple and we have full. The more sophisticated use full, and it goes down from there. But at the very least, you should always be doing simple job costing, direct materials, direct labor, and direct costs, and just all direct costs. All right. So now let's talk about the power of monitoring. All right. So we have we have monitoring at operational level, and we have monitoring at an accounting level. So let's talk about operations first. Are you monitoring your job performance? How often? Are you doing a budget to actual comparison on your job? Do you hold job cost meetings? And do you perform evaluations post-mortem? Okay. So if you have a job, let's say it's a 6-month job, you have an estimate, you issue the estimate, you're awarded the job. Okay. How often are you reviewing the financial and operational performance of that job? So do you say, okay, I started the job on January 1st. I'll just see how it did at the end of June. We'll just see how we came out, right? So we'll just do it by job. But what if you lost money? Well, that's the only answer you're going to get, right? But if I'm 1 month into the project or 2 months or 3 months, and I see things, maybe we missed scope, maybe we're off schedule, maybe I need a change order, maybe I can save it, right? Are you monitoring it on a regular basis? And it varies, right? It varies per contractor, it varies per job. If I have a job that's 4 weeks, I want to monitor it maybe daily or weekly, labor at least. If it's 6 months, I may do it monthly, right? So let the job dictate how often you manage the performance, but it has to be frequent enough that you can catch it before it gets out of hand, right? So just think of it, taking your hand off the wheel. You never want to take your hand off the wheel and let the job drive itself, okay? Budget to actual, right, per job at the end of the job, or even while you're doing it during the periodic monitoring, are you monitoring your budgeted cost to your actual cost, right? So if I'm building a commercial building and I got my grading contractor coming in, after he's done, I'm going to look and see what I budgeted for grading versus what I paid him. Did I go over? Why? Is it execution or estimation or an opportunity for a change order, right? Okay, so you need to always monitor your budget to actual. Because let me tell you, that's how your bonding agent measures you. Does that make sense? So think of it as a credit score. Your bonding agent's giving you a credit score to determine how much of a bond he's going to write, he or she, sorry, and how much they're going to charge you, right? Is it going to be 3%, 2%, or 1% for the cost of that bond, right? So the better you estimate, the better confidence they have in your ability to estimate, the more likely they are to write you that bond and charge you a lower premium because the risk is lower. The higher the premium, the higher their perceived risk. If you can lower that perceived risk, you can save yourself or your client some money. Okay. Do you hold job cost meetings, right? So job cost meetings are wonderful, and that as the job progresses. So the way that we used to do it is we had jobs that would go 6 months, 10 months, 2 years, right? So, but what we would do is on a monthly basis, we would sit around a conference table. Now you do it over Zoom, whatever. We would sit around on a conference table with the head of the operations or the owner, right? Could be both, may not, sometimes both, a lot of times both, and the project manager and the controller, CFO, and maybe the job cost accountant. And we'd sit there and we'd go through the estimate to the actual line by line. And it's a wonderful training opportunity from a multiple different directions, right? So from an accounting direction, we can look and see their budget to actual. If it's an operational issue, you've got the director of operations and the owner in there that can help the PM. Well, I'm having a problem with this, or I went over budget because of this. Well, the owner is going to say, well, if you did this, this, and this, or do this, this, and this, it'll fix the problem. And then you can get back on track, right? So job cost meetings are a wonderful way for the team to get together and all talk about their respective aspects of the job and how that they're monitoring the specific parts of it. So for example, when we go in for a job cost meeting, first thing we do is we look at budget to actual. Okay. Are you spending what you said you were going to spend? Then we look at your billings. Are you billing enough to cover what we've spent, plus put a little money in our pockets to pay the owners? Then does that billing, where are the status of the billing? So the accountant's going to come in and say, okay, yeah, we billed enough, but what's the collections, right? So is that job cash positive or cash negative? Because you can bill all day long, but if you're not bringing in the money, the job could still be cash negative, right? So you want to hold these job cost meetings on a periodic basis so everybody has their input on their piece of the puzzle and to make sure that it's working properly towards the completion of the job. Then at the end of the job, while you're doing it on a monthly basis, if it's a big enough job or an important enough job, maybe it's a new job, someone you never did before, you're trying to go into a new line or something, have that same team get together at the end of the job and do the exact same thing on a job level post-mortem. What did we do well on this job, right? So as the job progresses, you're just trying to keep the car driving, right? But it's like a football game, right? During the football game, you're just trying to execute the plays. After the football game, you all meet in the playroom and say, okay, we executed all the plays. What worked well? What didn't work well? What could we have done better? Right? Where did we go over? Did we miss it on execution? Did we miss it on estimate? How can we fix it for next time? Right? So that's what a good postmortem is you sit down and talk about how the game went and how your monitoring went while you were executing your plays, right? So then we do it. So that's operations, right? So monitoring the jobs is incredibly important. And you never want to let the job get out of hand, right? I have clients when, they go, how did we do on that job? Well, I won't know till it's done. Wrong answer. Wrong answer. You got to know while the job's going on. All right. So let's talk about accounting, right? Do you do budgets for your corporate costs, right? Do you budget your salaries? Do you budget your rent? Do you budget all of your other costs that it takes to run your company? And then do you monitor them, right? So at the end of the month, if we budgeted $5,000 for office supplies, and then I look at the financial statements and it says $20,000, why did we spend $15,000 in office supplies more than we should have, right? So if you think about each project manager is doing a job budget for each job, your accountant should be doing a job budget for the business, right? It's a 12-month project. It goes January to December. What's the budget for that job, right? That's one of the things when I was a CFO, that's one of the things that I used to tell the department is that we are a service center for operations. Operations service the company's clients. The accounting department's clients is operations. Does that make sense? We had a symbiotic relationship, but operations was executing the contracts and bringing in the money. So it was our job to do the best we could to make sure they could do that the best they could. Does that make sense? So it's very important that you're doing these budget to actual comparisons. All right. So look at monitor key ratios. What's the most important ratio in the construction industry? Nobody can interact, but I'll say it. It's the gross profit. Your gross profit ratio is the most important ratio. So are you monitoring that? January, we had 20%. February, we had 15. Why did our margin drop 5% in 1 month? That's a great question. If it was 20% the next month, and then it went back up 20%, why did it go back up? Right? I want to know why my margin's fluctuating. Because when I estimate a job at 20%, guess what? It shouldn't fluctuate. If it does, it should go up, not down, right? So if my gross profit's fluctuating, why? I want to know. We used to put a very low threshold. So at the time we were in the hundreds of millions, and even in the hundreds of millions, we would say, okay, if my job profitability changed $5,000 month over month, that project manager better know why. Okay. I wrote a change order. I missed an estimate. I incurred some cost. I'm waiting on a change order from the owner to come back to write it up, right? But you've always got to be monitoring that gross margin fluctuation. Do you do financial forecasts to manage the growth of your company? We did 10 million last year. What do we think we're going to do this year? We'll start with our backlog. We got $2 million in backlog. Well, I think we can go generate another 10 million in sales. So let's budget $12 million for this year. That's a great conversation to have with your bonding agent. We're going to do $12 million this year. Probably 25% of it will be bonding. What working capital and what equity do we have to have for you to write our bonds for these projects? Forecasts are huge for that. Do you manage your balance sheet? Do you know your bonding capacity, right? So I've given you a worksheet that Joanna is going to send out later, and it's basically a worksheet. So I've given you a couple, but one of them is a worksheet for working capital and equity calculation for bonding purposes. It's a rule of thumb. Everyone's different, but it'll give you a good gauge of where you sit, right? So do you know your balance sheet and bonding capacity? So the three most important things that bonding companies look at are character, capital, and capacity. Character is you, the owner. What's your integrity? Capacity is you, the owner, in your company. Do you have the skills? And capital is the money, right? So the money, and are you managing your balance sheet? They look at working capital is the number one ratio that they look at. That's current assets minus current liabilities. Okay. That's what they're looking at because that tells them how much money you have to fund your project. All right. And what they typically do is they say, okay, if you have working capital of $100,000, we'll give you a bond of 10 times your working capital. So if you have a $100,000 working capital, we'll write you $1 million per project job. Okay. But then if my equity is, say, $2 million, or let's keep it a little lower, say my equity is $1 million, they'll typically give you a bonding program of 10 times your equity. So if my working capital is 100,000, they're going to give me a bond for $1 million. And if my equity is $1 million, they're going to give me a bonding program of $10 million. So that means I could have 10 jobs of $1 million going on at one time, as long as the working capital increased. Does that make sense? So you want to manage your balance sheet. So when we go back and we talk about the balance that we want to bring between the financial and the tax books, right? We want to manage that balance sheet for our bonding capacity. Okay. So monitoring the operations, that's the project, and monitoring the company, that's accounting. And accounting does help on the projects as well. So monitoring is where you catch errors. It's where you catch people not doing what they're supposed to be doing. So error would be a mistake. Negligence would be someone not doing what they're supposed to be doing, right? So if you have these proper controls and you're monitoring them, once you put controls in, if you don't monitor them, they don't mean anything. So you monitor them to make sure that nothing slips in the company. And remember, like I tell people all the time, Amazon is the sum of its sales, right? So if Amazon has 1 million transactions, the sum of those transactions equal the sales of Amazon. The sales of a construction company is the performance of its individual projects, Does that make sense? So the sum of those projects equal the sum of the company. Where Amazon can't manage each individual sale, a construction company can manage each individual project. So it's a big difference. Does that make sense? Okay. So let's do another polling question. So how often are you evaluating your estimates? We'll go back to the chat. Do you say, okay, I bid the job, I'll look at it again, I'll never look at it again. So somewhere between the middle of the job, we'll stop and look at it. I'm not even going to look at it till the job's done, or we're going to look at it as throughout the life of that job. Okay, good. Okay. So I got 1B, midpoint of the job, 1D, periodically as the job progresses. I like D, right? So B, midpoint of the job, that may work depending on the job, right? If it's a shorter job, you may want to look at it more frequently. Longer job, same. But you get the gist, right? So, and there's no wrong answer, but D is the better answer. All right. Okay. So we talked about estimates. Again, they should be, they're used to win the job. They need to be evaluated for every change order. We want to look at the estimate when it's prepared. We want to review it, compare it to a historical if we're doing a like job. We want to monitor it as the job progresses. When the job completes, we want to do a post-mortem and we want to use it to bid our next similar job, right? So when I say estimates, there's two types of estimates in construction. You have the estimate to win the job, okay? That's the estimate you use to bid the job. And then you have the estimate to complete, and that's the estimate to complete the job. I don't want to sound redundant or simple. I'm leading to a point. So once you get that estimate, that's the estimate you win the job. That's your bid estimate. You probably will look at that to compare it to actual going forward, but it's going to change. You're going to get change orders. You're going to get buyouts, right? You're going to get efficiencies, economies of scales. So that original estimate will not end up looking like it will at the end of the project, right? So you want to make sure that that you get it in there, right? So that's the bid estimate. So once you bid it, it's gone. After that, it becomes what I call the real estimate, all right? And the real estimate equals two parts. It's the cost incurred to date and the total cost I have to complete that job, right? So if I bid a job for $1 million, cost of $1 million, right? And now I'm into that job, then I've earned $100,000 or incurred $100,000. So my estimate is the total cost is 100,000 plus the cost to complete that job, which may or might not be the other 900,000. It may be less for buyouts. It may be more for scope creep. Make sense? So you always want to look at a point in time and say, okay, this is how much cost I've incurred to date. What's the remaining cost to complete this job? That becomes my new estimate for the end of that period, right? So I'll tell you a story. So I did an audit several years ago, and it was a percentage of completion company. They were building boats. They weren't building buildings, but it was a very cool, still construction, but building boats. So I go in to do the audit, walk in, get the PVC list. The CFO hands me the job schedule. Here's the job schedule for the audit. Go audit the job schedule. So that's awesome, man. Thank you. It's perfect. Everything looks great. All the margins are good. All the overbillings are there. You're profitable. It ties to the balance sheet and the income statement. That's a great job schedule. I said, who did the estimates? Who did the job estimates? The CFO goes, I did. I said, okay. I said, how many boats you build? He said, I've never built a boat in my life. I go, how do you know how much, how do you know how much it's going to cost to build that boat? He goes, well, that's what the original estimate was. I said, well, hasn't it changed? He goes, oh, I don't know, maybe. I said, well, let's go talk to the general manager. So we go down and then we're at a conference table and we sit down with the general manager and, I go, well, this is what the CFO gave us for the estimates. I go, here's the cost that's been incurred to date on all of these jobs. could you do me a favor, please, and give me what your estimated cost to complete all of those jobs are? So he did, gave me back his estimate complete for all of those jobs. I took the cost incurred to date. I added them with the estimated cost to complete, right? And compared it to the original estimate, and it was severely wrong. So when I walked in there, they gave me a job schedule and financial statements that showed $1 million in profit for the year. Once I got done with the job schedule on the estimates to complete, the $1 million profit turned into a $4 million loss because they had not been monitoring their estimates. They'd not been looking at the estimates to complete. They set the original estimate in there and were done with it. The company was out of business in 3 years. So when I went back and met with the general manager, and I told him, I said, well, you showed $1 million of profit when I got out here. Based off the estimates you've given me, you really lost $4 million for the year. He looked at me, put his pencil on the table, didn't say a word, stood up, walked out of the job trailer, never said another word to me again. So you really got to stop and look at these estimates and say, just because I bid a job at an estimate doesn't mean that's what I'm going to finish it. So once that job gets bid, that estimate gets filed away. And from that point on, it is total cost incurred to total cost to complete. Make sense? Because that's going to be your true job cost. All right, so let's talk about some key ratios that you can use to monitor these, right? We talked about gross profit percentage is the most crucial, most critical, right? And it varies. It varies based off your industry. It varies based off your project size, your contract amount. So you could be doing a $100,000 contract at a 30% margin. You could be doing a $500,000 contract at a 20% margin, or you could be doing a $20 million contract at a 4% margin. 4% of 20 million is a lot of money, though, by the way. So it just depends on what is right for your industry and your type job. But whatever is right for your industry and type job, that's your benchmark going forward, right? Most subcontractors, I know that's going to sound crazy, but I mean, I'd like to see most subcontractors around 20%. I'd like to see most small contracts at $1 million or less at around 20%. And then once you start getting above that, then it starts getting a little lower. If you're a subcontractor making 5 or 10% gross profit, let's talk about that. Why? Is it the way you're estimating? Are you buying the jobs? Sometimes it's okay to buy a job to keep people busy to make payroll, right? Everybody does it, right? But every industry and every style job has an inherent gross profit. So you should be measuring to yourself that as a rule of thumb. Now, private companies are different, right? Everybody pads jobs, income statement's different, but use it as a rule of thumb. All right, net income percentage, that varies too. If you're dropping 5% all the way to the bottom line, you got to think that's pretty good. I've seen it as high as 20. That's outstanding, right? But what is the net income percentage? What are you dropping to the bottom line? Again, we talked about working capital. That's your working capital sets 10 times your bonded per job amount. Your equity to revenue, that'll set 10 times your bonding program, right? So what the bonding companies want to see is they want to see equity in your building. So if you come in and say, I got a $10 million construction business, but I take out all the money at the end of every year, the only person that's got risk in the next job is the bonding company, right? The bonding company says, you know what? We want to do business with you, but we don't want all the risk, right? This is your job. So maybe you want to share a little bit into it. So how about you keep your equity at $1 million, and then we'll be happy to write that bond because there's shared risk, okay? Then we want to look at underbillings or overbillings. So underbilling is where we've incurred costs that we haven't yet billed for. That means we paid for it. And overbilling means we've collected money or billed for costs that we have not incurred yet, right? If it's an underbilling, you are financing somebody else's job. If it's an overbilling, they are financing their own job. That's what we want, right? Sometimes underbillings are unavoidable. They're most common when the jobs start out. As that first pay app goes out, that should right the ship, definitely by the second one, right? But underbilling, and there are reasons for underbillings, but if you get to a 99% complete job and you got a $500,000 of underbillings, your bonding agent's going to look at that as a loss, not unbilled revenue. Right. So we don't want underbillings. Overbillings are good, right? But we want to make sure that we manage our overbillings. We want to be overbilled so that we're not financing our job, but we don't want to waste the cash that we collected in advance by maybe spending it on another job, or maybe the owner takes it out. Nothing disparaging to owner, but it does happen. So even though just because we're overbilled, which is where we want to be, doesn't mean we're where we want to be from a cash flow standpoint, right? So we want to monitor our underbillings and our overbillings, but I can guarantee you, if we're always underbilled, we're never where we want to be from a cash flow standpoint. Make sense? Well, we want to look at backlog in months, right? So one of the ratios that we look at as evaluators of construction company is we look at the end of the year and we say, okay, how much backlog do you have on the books at the end of the year? Do you have 1 month? Well, that might be a problem if you've got 3 months worth of fixed cost, right? If I've got 3 months worth of backlog and 2 months worth of fixed costs, that's a little better. We've got faith we're going to close some more contracts in the next couple of weeks, right? So we always want to look at our backlog in months in terms of revenue. And we also want to look at it in terms of gross profit, right? Gross profit's the most, that's the money. That's our money after a corporate cost, right? So we want to look at the gross profit too and make sure that we have enough gross profit in months to cover our cost as well. Because we can have a lot of revenue, but if we don't have a lot of gross profit, it may not cover our monthly expenses, right? So backlog in months and revenue in months, backlog revenue and backlog gross margin in months are great ratios to be able to use to evaluate where you are. AR turnover and AP turnover. I love these, right? I know these are a little technical, but I'm going to explain them to them in simple terms, right? AR turnover is how quickly you're collecting your money. AP turnover is how quickly you're paying out your money, okay? To the owner, to the subs, to the employees, to the vendors. They are how quickly you're collecting it from your customers, right? In the construction industry, what's one of most common, or a very common procedure on contracts, is the paid when paid clause, right? That means if I'm the general and I've got a sub who bills me and I bill my owner, that sub's not going to get paid till I get paid from that owner for that particular invoice, right? So I get my money from the owner, I get the money to the sub, we move on to the next month, right? So in theory, right, if you're paid when paid, you should always be ahead of the game. You should always have more cash coming in than you have cash going out. So one of the ratios that we look at is we look at AR turnover to AP turnover. So how quickly are we bringing in money versus how quickly are we paying it out? And if it's a negative number, that means we're paying out money faster than we're collecting it, right? So maybe we're having to dip into our line of credit and we're incurring interest. Maybe the owner has to put in more money and he doesn't want to, right? So if I have a negative AR to AP turnover, then maybe I want to see what's causing it, right? Because just putting more money in or paying interest on a line of credit while it solves the problem may not be the best solution. Maybe it's we're paying our subcontractors before we should, right? So a lot of subcontractors work well on paid when paid. A lot of labor contractors don't, because those laborers want their money every week. Hold on, I saw a question come in. Oh, let's go back. How can you have, let's see, the question was, how can you make that happen when you have a contract that is paid when paid? I'm not sure I quite understand that. Um,
I guess
let's-
what I'm
Yep, go ahead, Charles.
asking, I'm sorry. What I'm asking is that, okay, I just did a job paid when paid, and I got my mobilization, and I didn't get another check until 4 months later, and it was always they hadn't gotten paid yet. By that time, I'd already finished the job, so essentially, I I did their job for free, to a certain
Yeah.
extent.
Don't work with them again. No, I mean, I know that. Trust me, I'm a business owner too, right? I understand the realities of bringing money in, right? But that is the truth of the matter. If you're a subcontractor, you want to work with generals who value you as much as you do, right? So one of the things, every company has their flaws. The owner of the company I work for, I'll never give him enough credit for, was he treated his subs like gold. We never withheld money from a sub. We never made them wait. The only time we did is, there are certain things that they have to give us to be able to get it. They have to get their pay application, their lien waiver, stuff like that in. But as soon as they got it in, we would cut them a check. I mean, every general contractor's success is built off the success of their subcontractors, right? So if your subcontractors aren't successful, they're struggling with cash flow, that's not going to bode for you in the long term, right? So what I would simply do, what we would do, right? You can't make them pay, and the truth of the matter is they probably were paid and they just didn't want to give you the money. I don't know why that's a game some PMs play sometimes, but I've seen it happen. I wouldn't let my PMs play it. I would say, we've been paid, go pay that sub right now, or I'll pay it, or authorize the payment, or I'll pay him, right? So what you want to do is, if it's an owner or a PM that you're working with, talk to them, right? Say, look, man, I don't want to stop working, but I can't. I got payroll to make, right? And I know you've been paid. I mean, you know when they've been paid, right? So maybe make it a more human relationship, or just stand a little firmer. Unfortunately, that's about all the advice I can give you. Does that make sense?
Yes, I understand. I think that going into another situation like that, I'll definitely get more money up front,
Yeah.
so that it can carry you through. But yeah, I knew they were getting paid, and they just messing around.
Yeah.
But
I knew they were
they
getting
were
paid.
so big that, you try to get that, work under your belt from these, contractors that in that $1 billion range, so you can get something else from them. But then, like you say, you got to look at it and say, does it really make sense?
Well, and they know, they know you're trying to do that too. See, I told you I knew they'd been paid. You know how I knew they'd been paid? Because they kept working on the project, right? That's how I knew they kept getting paid. But then I knew they weren't paying you because that's the game they played, right? So it really is unfortunate that they do that. And they know that you need them to get bigger too. So sometimes that's a game they play. You just have, as a business owner, you have to say, is it worth it? Right? I've had a business model that I only want to work with contractors. It's just all I like to work with. I get referrals from manufacturers. I don't take them. I get referrals for lawyers. I laugh at them. And just, that's a lawyer joke. I don't like working with lawyers, so I don't work with them. The only people I want to work with are contractors, because I like them as people. They're generally good people. They generally want to do the right thing, and they generally value what I bring to the table. That's a great working relationship. You want your GCs to treat you the same way as a sub. Does that make sense? All right.
Um,
So
Josh, this is Deani with the City of Savannah.
yes, ma'am.
Excuse me. I just wanted to interject for a moment. Excuse me. I heard Charles ask the question about him being paid, and a couple of questions I wanted to ask Charles. Where are you located?
I'm located out of Atlanta, Georgia, but the job was in Dallas, Texas.
Okay. One of the things that Josh said, and excuse me, I'm trying to get over bronchitis. One of the things that I heard Josh say was relationships. I try to tell my subcontractors all the time that it is so important that you have a relationship with those contractors. You need to try to be their best friends. Um, it's your job and you have to know it. So you need to be their best friends. But the other thing that I was going to ask, and I know things probably going to change here certainly soon. I heard Josh also say he wants to work with contractors. You say you're in the Atlanta area. Are you a DBE?
Yes.
Okay. So normally, here in Savannah, We check our jobs, so we know we make a 30-day pay. So I have a relationship with my DBE contractors. If they're not getting paid, they're gonna call me. But at the same time, we do a lot of monitoring of our projects. We call our subs, we make sure that they're getting paid, that they're not having any problems on the job site. So that's another relationship. So whomever your DBE coordinator, whatever county you in or whatever, make friends with them as well so that you can make sure that you're getting paid on that job, because we have the ability to stop those payments until they get it right. So that's just some advice I wanted to give you.
All
That
right,
was
thank you.
awesome. Awesome. Thank you so much.
Thank you.
All right. So those are all the good ratios that you want to look at, right? So, again, monitor the AR to AP turnover. We don't want to finance other people's work. All right. So we'll go on. Polling question number 4. All right. Who maintains a formal work in progress schedule? Yes, no, never heard of it. Anybody? Ooh, okay. I didn't get an A. So opportunity for improvement, right? So, wait a minute. I got one more response. Oh, okay. I did get one A. Yay. Okay. So, all right. Got one of
I'm
each, right?
sorry,
So,
that was me. I was just late trying to hit the button.
that's all right. So A is great. I love the work in progress schedule. If you're not doing it and you're not sure what it is, let's learn, right? So the way that I approach consulting with the owners is you're the owner of the company, right? You don't want to look through at every job estimate. You don't want to look through every budget to actual. So what I do is I come in and I teach the owners and the accounting department how to manipulate that job schedule so the owner has a one-page form to look at so he can see, oh, this job looks good, no fade, it's properly billed, it's cash positive, boom. So what I try to do is take the owners to monitor the projects holistically using the WIP schedule. I've given you an example of that in the packet. It's not a full WIP schedule, but it's some manipulations that you can make to your existing WIP schedule to kind of monitor some progress. So it'll show you a fade analysis, it'll show you your over under, and it'll show you your cash position on the job, right? Just because I'm overbilled doesn't mean I'm cash positive. Okay. So I love the work in progress schedule. It's when I do an audit or I do a review of a construction company, 80% of my time is spent on the work in progress schedule because that's where all the value for the construction company is. So very, very, very important, especially as you grow and your jobs get bigger. All right, so let's go over some best practices. I'm running out of time. Got about 20 minutes. All right, so best practices. The goal is real-time information, right? We're in a real-time world. Amazon delivers same day, right? Everything's instant, 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 instant. And anybody that's a professional service provider, and GCs are professional service providers, professional service can't be instant, 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 right? So, but that's what everybody expects, right? I call it the Amazon rule. They set the pace. So we want all vendor invoices to be recorded daily, right? There should never be a stack of vendor pay applications or invoices sitting around to get entered in, right? They should be entered in every day and they should be complete before the AP person goes home at the end of the day. All owner invoices are to be recorded upon issuance, right? No hesitation. The minute that gets issued to the owner, it gets recorded in AP, right? I mean, in AR. So that way we know how much we're owed and we know how much we owe, right? Conduct your job cost meetings every month. If it's a monthly periodic, if it's a 4-week job, you may want to do at least weekly. Maybe on the Monday morning safety meeting, go over labor hours, budget to actual, at least on labor hours, right? Conduct the postmortems as we talked about. Reconcile cash and credit cards monthly, all right? Every month, reconcile to the T. Perform a hard close every month on the balance sheet and the income statement and the cash flows. All right. So what do I mean by that? So a lot of people will go in at the end of the month and say, I reconciled my cash and I reconciled my credit card. All right. I have one of my employees on here, Angel. She'll agree, right? Just because you input something in doesn't mean the output is correct. Okay. So just because I reconciled my bank account, that just tells me I got all the transactions that went through the bank account. It doesn't tell me that they were all coded correctly, right? I won't know that until I go reconcile fixed assets, or until I reconcile AP, or I reconcile prepaid expenses, or I reconcile distributions to the stockholder, right? Just because I've got all these accounts reconciled for cash and credit cards doesn't mean the other accounts are correct. So when I say do a hard close, you have all these accounts on a balance sheet. You go through every account on a balance sheet every month. I know what my cash balance is. I know what my AR is. I've got my fixed assets recorded, depreciation booked. I've made all my note payable payments, the principal's against the loan balance, the interest is to the interest expense, right? I know this every month because it'll give you an accurate financial picture of your company every month, right? Hard close every month, reconciling cash accounts, reconciling credit card balance or accounts alone is not a monthly close. All right. So hard close every month. And that means doing a job schedule and reconciling that job schedule back to the balance sheet and back to the income statement, because they will all tie in together. All right. Perform and review project and company analytics should be done by accounting and with management, right? So just because we do all these analytics and we throw all these numbers out there, somebody other than the accounting department needs to understand them, right? And needs to understand their trends. Okay. And then again, we've talked about managing your balance sheet. Strong financial, weak tax. All right. So I like schedules, right? I'm a very regimented process type person. I'm a CPA. What would you expect? I'm a former military, right? So I'm a process till I die kind of person, right? So if you set up processes, you don't have to think and you don't have to worry, because it's the process. It's what we do and it accomplishes what we want. So I don't have to worry, right? Deposits daily, checks to vendor weekly. You don't need anybody busting into the accounting department saying, I got to have a check right this minute. That's about 1% of the time, although the project managers think it's a lot more. It's not, right? Manage it. You're managing your cash flow. No, we're not going to cut checks till the end of the week because that's what we've budgeted. Record vendor invoices daily. Record payroll and job cost per payroll, right? If you have a 4-week job and you have them enter in time daily, you may want a job cost daily, labor. But if you have a monthly type periodic review monitored job, then recording it per payroll is fine. Remit payroll taxes as soon as you submit the direct deposit every single time. I know you got a couple days, don't mess around. They do not forgive on payroll tax penalties. They do not do it. All right. And for example, if you don't submit your Georgia when timely, it could be a $3,000 penalty the first time, no abatement. So on payroll taxes, remit them same day, all the time. Record fixed assets as they're purchased. If they've got a note payable, as it's incurred, set them up together, record the transactions, true accounting, right? Allocate indirect costs and prepare financial statements regularly and timely on a monthly basis. If you go into 2 months, if you're in closed January and you have to wait till March, or you have to wait till 2 months after the month to get your financials, you need to work on your internal processes. You need to be reviewing, and construction is a little different. You can go a month, but you don't want to go more than a month, right? So when I was at GC, our subs wouldn't even bill us till the 25th of the month, right? So we had to do job costs and all of that. We probably wouldn't issue financials till the 25th of the following month, maybe the 20th, right? But you don't want to go to the 5th of the second month, right? So if you get these routine transactions, you follow them, you'll never have to worry about it. All right. So, and then I say come up with a schedule, right? There's no reason in today's technology with the way the information flows, there's no reason why your bank accounts can't be reconciled by the 5th of every month, because they get the bank statement the next day after the month ends, right? Same with your credit cards. Same with your accounts receivable. You don't want to wait 3 weeks after month end to be issuing vendor or owner invoices. You want those owner invoices to go out by the 5th day of the following month. We'll record fixed assets and depreciation. close job costs. Why is it a little different? Because you have to have your project managers in on job costs. So you close job costs, then they get the time to go in there and look at the cost to date to be able to figure out the estimated cost to complete. Okay. Hold job cost meetings every month, no exceptions. Project managers will get it, expect it, love it, need it, right? Financials issued to management, review the financials with management, right? Sometimes the accountants will be like, hey, boss, here's the financials. Well, the boss may or may not look at them. Sit the owner down in your office or go into the owner's office and sit down with the financials and the ratios that you come up with and say, profitable this year, great working capital, good equity, no profit fade, good margins. That could be the end of the conversation, but at least you have 3 pieces of paper with numbers on there and you sit down and go over them with the owner, right? If the accountant has all the knowledge and isn't telling everybody, it doesn't do everybody any good, right? All right. So now I'll talk. So those are best practices. So let's conclude, right? So we've talked about, the 5 best practices for successful contractors. We've talked about monitoring, managing, hard closes, and coming up with your internal schedules, right? Those are all great. So if you need more training, right? There's a lot of different ways out there to get construction training. But there's an organization in Georgia. It's a national organization, but Georgia has a chapter. It's called the Construction Financial Management Association. We meet once a month. I'm on the board. And our sole focus is construction education for financial professionals. We do some operations as well. So, but ours is financial professionals, lien waivers, contracts, retainage, budgeting, cash flow, job schedule, anything that you can think of, insurance, right? Anything that the accounting department or would, want to know, we talk about the CFMA. The Associated Builders and Contractors, that's mostly subcontractors, mostly operations. So they'll train your project managers, your supers, safety. They have an excellent safety program. And then the Association of General Contractors, that's basically a combination of the other two, but for the really big guys, right? So that's your Bats and Cooks and some other people in there, right? But if you are a business owner and a construction business owner and you have an accountant in your business, they need to be part of construction of CFMA, Construction Financial Management Association. And I'll tell you why. So again, I don't get any commission off of it. It's not for profit organization, right? But it's $400 a year for them to join and for them to be a member of it. But there's what's called the general connections for CFMA. So if you're a CFMA member, you get a membership to General Connections, which is an online chat room to CFOs and construction controllers and construction companies all over the country. So if you say, hey, I'm thinking about taking on a new job. I don't know anybody in Georgia. I'm going to go to CFMA and say, hey, has anyone built a cold storage warehouse? I've got questions. And you'll get 30 responses from contractors in your same line of business almost instantly. It's a wonderful platform for other contractors that have your same problems. Oh, what project management software do I use? You'll get 30 responses. This is the one we think's the best. I've got this accounting system. Which project management software integrates with there? You'll get 30 responses of people actually using it. So CFMA is a wonderful organization. I can't say enough about it. And again, we're talking about accounting and bonding, and that's what it's geared for. So we have a meeting in 2 weeks, and it's actually a surety panel that's talking about surety and bonding and the state of the construction industry in the United States right now. So that's just some of the kind of things we talk about. So we also do annual conference. CFMA does a annual conference as well, but we do a regional conference, and it's for Georgia, Tennessee, North Carolina, and Alabama. I think Mississippi's joining this year. So more Southeast regional, right? But we go for 3 days up in Chattanooga. We've got I don't know, 17 speakers, classes that come in and educate you about everything from HR to payroll to legal to contracts to tax updates to insurance to everything that you could possibly think of, right? So it's a really great educational opportunity. And this will be in August of 2025. So again, I'm just trying to help you get more educated about construction specific topics, right? And then, so what I'll challenge you to do, so we've gotten some good answers. So Beth, who used to run this, always made me give you guys homework, right? So I'll let you choose which one you want because there are so many things that you could probably look at to say, yeah, I could probably make some changes here. So review your estimate, right? And compare it to your job cost. Are they similar? If they are, great. If they're not, maybe we want to tweak one or the other to get them in line. Okay. Review the items that you are job costing to make sure you're capturing all the costs of the related projects. We know about direct costs. Those are easy. Are we going to capture some of the indirect costs that we're paying for to do that job? Schedule, set a schedule for processing routine transactions, right? I showed you one. So find one that works for your company where you can say, I'm going to do AP invoices every day. I'm going to record them every day so I know what our job cost is at any given moment. Okay. Set a schedule for your monthly close, right? Financials by the 25th of every month. Sit down and you're going over them with the owner. If you can accomplish that, excellent. Review your ratios. Do that with the owner, right? Always monitor that gross profit. It's the most important ratio in industry. Pick one completed job during the year, gather the project team, and go hold a postmortem. Review the estimate, review the actual, review the schedule, review the internal administrative compliance. What do I mean by that? Did AP record vendor invoices timely? Did vendors get paid timely, right? We talked about that in depth a few seconds ago. Did the owner invoices go out timely, right? Did we bill our customers in a timely fashion to be able to collect our money? Did we, not only did the invoices go out, did we collect it timely, right? So you can look at one job and say, the estimate was good, the execution was bad, we got all of our vendors paid timely, got all our invoices collected timely, we just didn't make as much profit as we thought we were going to. That's a great postmortem. You figure out why you didn't make as much profit, then fix it for the next job, right? So take one of these six, or take all six of them if you're an overachiever, and go challenge yourself to look at these and see how your company is doing these six things within your company to help you achieve your goals. Okay. So if you have questions, this is a QRC code. Point your phone at it, click. It'll give you my QR code or my VR code or VR card. Just save it to your contacts. If you have any questions, comments, concerns about the presentation, you need guidance on seeking more information, then reach out to me. That's part of what I offer as part of being an instructor for this course is I'm here to help. Right. You know, I love small contractors, growing small contractors, the big contractors. That's how I measure my accomplishments. You know what I mean? Taking a $15 million contractor and watching them grow and helping them grow to a $75 million contractor. That's where I get reward for my job, right? So if you have questions, feel free to ask, right? And I'll help out as best I can. Just understand this is kind of our busy season, so it may not be an immediate response. So at this time, I'll stop for questions since we got about 6 minutes left. Is that okay, Joanna?
Perfectly fine. I was gonna ask anybody if they had any questions they wanted to shoot at you for the last 10 minutes, 5 minutes. Okay, speak now, forever hold your peace. That means you did your job really good then, Josh.
Well, thank you for saying that. I'll take it. I will take it. I appreciate it. I'll conclude, and since there were no questions, what do I think about Sage 100? It's a good starter, right? So I'll make a point on that. Pick a package. Sage 100 is perfectly fine. QuickBooks is perfectly fine. There's some other ones out there too. Pick one and then let it limit you. Use it so much that it forces you to upgrade. So you start with Sage 100, use the project management module, use the change order manager. And then once it starts limiting you, then you know it's time to move on. But most people will get an ERP system or an accounting system and they'll use maybe 20% of it. So yeah, if you use 100% of Sage, it's a great starter package, 100%. Anybody else?
Annabelle, you can unmute yourself if you have more questions.
No, it was just that because we just trying to start using that software, but there are a lot of talks between QuickBooks and Sage 100. I just needed to know his opinion because he knows what he's talking about.
Well, thank you. So that's a great stopping point, right? So we upgraded our ERP system from a lower level QuickBooks to Sage 100, which is built for contractors. That's an opportunity where you want to say, we are implementing new technology in our company that could be eligible for the Georgia retraining credit. Does that make sense? So that's a perfect question to lead to a perfect example of a tax credit that you should be on the lookout for as you operate for things you're doing anyway. So with that being said, and there are no more questions, I've really enjoyed this. I know all I did was talk, but sometimes I enjoy that. So and I enjoy being back here again for multiple times. I can't remember how many times, but it's always a pleasure. Thank you, Joanna, for having me. And again, if anybody has any questions, feel free to reach out.
All right, thank you, everybody. The homework assignment will be immediately following this class for the project management and the estimating and bidding, and I'll include Josh's worksheets that he said he wanted you to have. So be looking for that in the next 30 minutes.
Great. Everybody have a nice evening. Thank you.
You too.